lecture number 18 of module 3, that is income under heads profits and gains from business and profession, under subject direct taxation. So as we know that this particular module covers computation of income from profits and gains from business and profession, which we have already seen in lecture number 16, the basic method of accounting, scheme of business deductions and allowances. So we are remaining with deemed profits. What is deemed profits? What is maintenance of books, depreciation, and problems on computation of income from business and profession of individual SSC and depreciation. So today we will be covering what are deemed profits, maintenance of books and depreciation. All this is a theory part. So before we begin with what are deemed profits, let us understand how to compute the income from business, profits and gains from business and profession, which is covered under section number 29. So as I'm again revising this particular format because this is very important. So we always start the computation with the net profit as per the statement of profit and loss account. Then to this we add all the expenses which are debited to P&L account but which are not allowable as per the provisions of profits and gains from business and profession. Then we deduct all the expenditures which are allowable, which are allowed to be deducted but they are not debited. Then we less incomes which are actually not taxable under this head. We know there are 5 heads of income, but we are going to less all the incomes which are not taxable under this head or which are taxable under some other head. Then we add the deemed income or deemed profit, which we are going to study today. Then we get profits and gains from business or profession. This concept is already known to you all. What are deemed profits or deemed income? I had given a few examples. Today we will be seeing in detail. Then once you add this, whatever you get is profits and gains from business or profession, and this is the income or this is the profit on which you will charge the tax. So moving ahead, profit chargeable to tax or deemed income. So let us understand what is the meaning of this deemed income or profits chargeable to tax. Whatever we are doing in our calculation in the P&L account, that will not be reflected as a deemed income. That will be your regular income, source of income. But let us understand what is the meaning of deemed income. So first, recovery against any allowances or deduction allowed earlier. Now, what do you mean by this? Suppose if we have taken any deduction or any allowance in any of the previous assessment year, suppose it can be a loss deduction, an expenditure deduction, or a trading liability, correct? Now, suppose if subsequently we have recovered that amount either in cash or either in kind, then whatever amount we have recovered because of an expenditure which we had claimed, the benefit of which we had claimed in some earlier years, and now we are recovering that, then that recovery of that particular expenditure, loss, allowance, deduction becomes our profit chargeable to tax, or it is called as a deemed income. So all these are nothing but some few categories which will be treated as a deemed income if received. So I hope you'll have understood the first part. Recovery against any allowance or deduction allowed earlier means in any of the earlier assessment years you have taken the benefit of that allowance or deduction, and that is an expenditure or loss, and in the previous year, in the year in which you're computing income, you have recovered that amount. And if you have recovered that amount, it is going to be your deemed income, which you have to add at the last in order to get the exact profits and gains from business or profession. Next, balancing charge on asset of an undertaking engaged in the generation and distribution of power. So students, suppose if any asset, now asset means it can be any building, furniture, plant, machinery. So suppose if that asset is being owned by the SSE, it should not be rented. If it is owned by the SSE, and if depreciation is claimed on that, and if it is used only for the purpose of business, and suppose if that particular asset is sold, or maybe it is discarded, or maybe it is demolished, or it is given in scrap, then whatever amount you are receiving on the sale of that asset, if that amount is exceeding the written down value, then such excess becomes your deemed income. So that is a sale of asset. Okay, sale of asset on which depreciation has been claimed, on which the owner, SSE is the owner. And if you're selling such asset, and if you're recovering more than the written down value of the asset, see, every year you calculate the written down value of an asset, and suppose if the sale value is more than the written down value, then such excess is going to be your deemed income. It is going to be your profit, which you have to add it back, in that format that I have shown you all, in order to get profits and gains from business or profession. Next, profit on sale of a capital asset used for scientific research. Suppose if any capital asset which is used for a scientific research is again sold, okay, but it should be used only for scientific research and not any other purposes, then whatever sale value you are getting, if it is exceeding the amount of expenditure that you have incurred on its purchases, then such excess will be chargeable to tax as a business income, and it will be treated as your deemed income. Next, recovery out of the bad debts allowed as a deduction earlier. Suppose if any bad debts, you all know what are bad debts, right? So if any bad debts has been allowed as a deduction, we know that bad debts are allowed as a deduction under section 36 we have seen. So suppose you take it on the debit side in any of the particular assessment year, thinking that the debtors are not going to pay back the money, it has become bad. So, but in the subsequent years, you recover a part of that amount or the full amount, then whatever excess that you have realized from that bad debts, it will be charged as a business income, okay, in the year in which you have getting that amount. So again, it will be treated as a deemed income whenever you are recovering the bad debts. Next is amount withdrawn from special reserve created and maintained by certain financial institutions. So when a deduction, actually in respect of this, a deduction is allowed, okay, as per section 36. Suppose if that amount is withdrawn.
Hello, ma'am.
Yes.
Ma'am, some of the students are waiting to join.
Yeah, they can join here. I'm accepting.
Okay, ma'am.
Okay. Amount withdrawn from special reserve created and maintained by certain financial institutions. Usually financial institutions maintain certain kind of reserves, okay, where they keep a certain amount of their profit under those reserves, for which they get a deduction for keeping the amount in the reserve. But suppose subsequently in any of the assessment year, they are withdrawing that amount that they have kept in the reserve, then the amount that they are withdrawing will be considered as a deemed income, which will be again chargeable to tax. Next, adjustment of loss. Now, students, as we know that like we'll be studying in the module number 5, where any loss of a business can be carried forward for a period of 8 years. And this loss, when it is carried forward in the 8 years, it can be adjusted against the profits of any other business, which in detail we will be studying in module number 5. But if you are adjusting any loss, okay, then such loss what you're adjusting will be considered as a deemed income, and it will be added to your profit. So in what does this exactly means is, Suppose if any business or profession is discontinued, or suppose if any business is not a speculation business, then what happens is, if it is discontinued, then such loss has to be adjusted against the income of any other business. So such adjustment of loss will be considered as a deemed income. Next, recovery after discontinuance of business or profession. So what does this mean? This means that when any business has been discontinued, okay, and actually when the business and profession was being continued, you were supposed to receive some amount from, suppose, any debtor or any of your client, but you have not received it, and after you have discontinued the business or profession, you are recovering the amount. So the recipient who is receiving the amount, it will be considered as a deemed income in his hands, and it will be chargeable to tax. So it is recovery after discontinuance of business or profession. That is where any amount is received after the business or profession has been discontinued, then such income will be treated chargeable to tax in the hands of the recipient, okay, and will be included in his total income. So these all are the situations where profits are chargeable to tax, and it will be considered as a deemed income and added to your business and profession in order to calculate the profits and gains from business and profession. So students, have you understood this 7 points? Anyone has any doubt in this 7 situations where it will be considered as a deemed income? Yes? Any doubt?
No, in adjustment of loss, ma'am, I got confused.
Okay. See, what happens is, generally loss of a business can be carried forward for a period of 8 years. Okay. Like suppose if you're having 3-4 businesses and you're incurring loss in one particular business. Suppose you have a textile business, you have an automobile business. Okay. You have a multiple lines of businesses. So the loss of any particular business as per the Income Tax Act can be carried forward for a period of 8 years. Okay. Now, what happens is, this adjustment of loss will be applicable in case of deemed income. Suppose if the business is being discontinued, suppose the textile business, you're discontinuing the textile business, then what happens? The unabsorbed loss pertaining to the year in which the business or profession was discontinued, like if the textile business is making a loss of suppose 10 lakhs, okay, and it has been discontinued, then such loss will be allowed it to be permitted with the income of some other business, correct? So such adjustment of loss will be added as a deemed income. Is this
Yes, ma'am.
clear?
Yes, ma'am, got it.
Okay.
Okay.
Okay. Anyone has any doubt in this 7? See, students, in detail, I'll be giving you all the notes. I'm just explaining what is the concept of each of these points. In detail, you will be getting the notes for all once we finish the module. Anyone has any doubt in any of the 7 points, or should we move ahead?
No doubt, ma'am.
Okay. Let us move ahead to maintenance of books. Now, students, tell me, what is the meaning of maintenance of books? Every person or every SSE who is carrying out a business or profession has to maintain books, right? So here that in this maintenance of books is covered under section 44AA, where they are telling us that who is required to maintain books, who is not required to maintain books, when should an SSE maintain book, what is the limit after which he can maintain the books, where the books have to be kept. Okay, all this is covered under maintenance of books. Now by books I mean books of accounts. By books I mean books of accounts like your cash book, your journal, all your ledgers. Okay, so let us start. Now this section provides that every person, you all know who all is covered under persons. So every person carrying on legal, medical, engineering or architectural profession or accountancy or technical consultancy or interior design, decoration or any other profession which has been notified by the CBDT in the official gazette must statutorily maintain books of accounts and other documents which will enable the assessing officer to compute his total income in accordance with the provision of Income Tax Act 1961. So students, by this slide we mean that all the persons which are carrying out these particular profession which is mentioned here, okay, they have to maintain the books of accounts, have to mandatorily maintain the books of accounts. Why they have to maintain the books of accounts? So that the assessing officer, with the help of the books of accounts, he can compute what is the correct income of the particular assessee or a person. Now, remember this list: legal, medical, engineering, architectural, accountancy, technical consultancy, interior decoration, other profession which will be notified by the CBDT, Central Board of Direct Taxes. Next. Now, section 44AA subsection 2 talks about that. In case of an, first I'll just explain you all and then I shall read this slide. Suppose if any person is an individual or HUF and he is carrying out any business or profession which is not specified here, means other than this, other than legal profession, medical, engineering, architectural, technical consult, other than this, if he is carrying out any business or profession, okay, and he is an individual or HUF, then he is required to maintain books. Suppose if it is an existing business means he's carrying out business for a multiple number of years, his business is continuing, then he is required to maintain books only and only if his turnover exceeds 2,50,000, okay. And suppose if he is carrying out business or profession, then his turnover exceeds 25 lakhs in any one of the 3 years immediately preceding the accounting year. So suppose if the financial year, if we are taking it as 1920, immediately preceding 1920 in any of the 3 years, if his turnover, if his income is exceeding 2,50,000 or if his turnover is exceeding 25 lakhs, then he is mandatorily required to maintain the books of accounts only if he is an individual or HUF, and that too if he is carrying out any business or profession which is not covered in the previous slide, that is legal, technical, interior decoration, we have seen that. So apart from that, if he is carrying out any business or profession, then when he is required to maintain books of accounts only when income exceeds 2,50,000 or the turnover exceeds 25 lakhs in 3 years immediately preceding the financial year. Suppose if it is a newly set up business or profession, suppose this is the first year that I'm starting my business or profession, then when am I required to maintain my books of accounts, start maintaining my books of accounts? That is when my income exceeds 2,50,000 or when my turnover exceeds 25 lakhs during that particular previous year. Suppose in this financial year 1920, if my income is likely to estimated to exceed 2,50,000 or my turnover is likely to exceed 25 lakhs, then I am supposed to maintain the books of accounts. So students, have you all understood this particular slide? It is very simple. Have you all understood, students? Quick. Students, have you all got what this slide means?
Yes, ma'am.
It means that if any individual or HUF is carrying out any profession which is not specified in the one above, that is the slide, previous slide, then he is required to maintain books of accounts only and only where his income exceeds 2,50,000 or where his turnover exceeds 25 lakhs in the If it is a newly set up business, in the previous year, and if it is already existing business, then in the previous 3 years preceding the current previous year, any of the 3 years, if his income exceeds that limit, then only he is required to maintain the books of accounts. Next, suppose if that particular person is other than individual or HUF, then he is required to maintain books of accounts only when his income is exceeding 1,20,000 or where his turnover is exceeding 10 lakhs in any one of the 3 years immediately preceding the accounting year. And suppose if it is a newly set up business or profession, then where his income is exceeding 1,20,000 or where his gross receipts or gross turnover is exceeding 10 lakhs during the previous year. Yes, if this limit has been exceeded, then he is required to maintain the books of accounts. Next, maintenance of books under section 44AA3. We have seen under section 44AA AA subsection 1, subsection 2, and now subsection 3. Showing lower income as compared to income computed on presumptive basis under section 44AA AE. So students, first, what is section 44AE? Let me tell you. Government, in order to relieve the burden on small business people, government has come up with a taxation of presumptive basis. Like these particular set of businesses can show their income on presumptive basis, and they need not maintain the books of accounts. So what is 44AE? A business of the business of hiring and leasing goods carriage. If any person is into the business of goods carriage, where they are carrying the passengers vehicles or passenger transport, okay. So if they are into that lease carriage where they're carrying the goods, okay, so they can follow the presumptive taxation scheme where they have to pay tax on a certain particular amount. But suppose if they are showing their income lower than that presumptive taxation scheme, then they are required to maintain the books of accounts. So just remember, if as per section 44AE, they are business people who are doing the business of lease carriage, leasing goods carriage. If they're doing that business, they are into the presumptive taxation scheme. And if even though they are under this scheme, they are showing their income lower than that scheme, then they are required to maintain the books of accounts. Next, section 44AA subsection 4, like section 44AD. Section 44AD is nothing but it is applicable to those businesses who are who again fall under the presumptive taxation scheme, okay, where they have to show their income at 8% of their gross turnover. Now suppose if they are showing their income less than 8% of their gross turnover, then they are required to maintain the books of accounts. That is what is being explained in this particular slide. Next, now I have told you all that any person who's carrying legal, medical, engineering, architectural, professional, accountancy or technical consultancy or interior decoration services, profession or business, if they are carrying out any such profession or business, they are required to maintain books of accounts only if their gross receipts exceeds 1,50,000 in all of the 3 years immediately preceding the previous year. And suppose if it is a newly set up business or profession, then if his gross receipts is exceeding 1,50,000 in that particular financial year, then only the persons who are carrying out these particular set of profession are required to maintain the books of accounts. So here we have seen totally 5 categories. First category is we have seen an HUF, an individual not carrying out legal, medical, engineering, architectural, all these services or all these professions. What is the limit after which they have to maintain the books of accounts? Then we have seen in case of persons other than individual or HUF, then we have seen the situations where suppose if they are covered under 44 AE and 44 AD, and even after being covering under that taxation scheme, they are showing lower income, they have to maintain the books of accounts. And lastly, we have seen that any person carrying out legal, medical, engineering and all these services, when they have to maintain the books of accounts after they cross 1,50,000. Next, prescribed books and accounts and other documents. Like what are the different set of documents that they have to, or the different books that they have to maintain is a cash book, a journal, okay, a ledger, then all the carbon copies of the bills and receipts. Usually when any you even when you go to a shop, when you get an invoice, the original copy is given to you all and the carbon copy is kept with the shopkeeper, and that carbon copy of the bills or invoice has to be serially numbered. Okay, then original bills and receipts. In case of purchases, suppose if any business is making purchases, then the original bills of that expenditure has to be maintained, payment vouchers has to be maintained, and that has to be properly signed. So all these documents are required to maintain, because these are the basis on which you're going to prepare your P&L and balance sheet, and then you're going to determine your income based on these documents or books of accounts. So these are the prescribed books of accounts that has to be required to be maintained by all those who exceed the limit that we have seen in the previous slides. Now, place at which the books to be kept and maintained. Where should a particular SSE maintain those books? So suppose if an SSE is having a particular business, okay, he has to maintain the books in that particular place where he's carrying out his business, correct? Suppose if I'm having a one particular place of business, I am required to maintain all my books at that particular place of business. Suppose if I'm having more than one place of business, then I can keep the books of accounts in the principal place of business. Principal place of business is the main place of business which I have registered. And suppose if I am maintaining separate books of accounts in each place of business, I have more than one branch, and I'm maintaining the books of accounts separately at each branch, then the respective places where I'm maintaining, that should be the place where the books to be kept and maintained. So let us see. The books and documents shall be kept and maintained at the place where the person is carrying on the profession, or where there is more than one place, then at the principal place of his profession. However, if he maintains separate set of books for each place of his profession, such books and documents may be maintained at the respective places where he is carrying out his business or profession. So by this we have completed the maintenance of books of accounts. Students, this is complete theory. Have you understood what who has to maintain the books of accounts, where it has to be maintained, and how it has to be maintained, which all books of accounts are supposed to be maintained? So are you all clear with maintenance of books of accounts? If yes, we will move ahead with depreciation. Yes, students? Students, are you all there?
Yes, ma'am.
So you have understood what is maintenance of books of accounts. In my last 5 minutes of my class, I'll be having a Q&A session. Okay. Next, depreciation. See, students, depreciation was covered under section 32, which I told I will deal in later. So now we will be dealing in it. First of all, what is the meaning of depreciation? As you all know, depreciation is nothing but the fall in the value of an asset. An asset, when there is a fall in the value of an asset due to maybe tear and wear, obsolescence, new technology. Okay, so depreciation is usually and always charged on an asset. Okay, now what what does it have impact on this income tax or profits and gains from business or profession? So let us see. Remember, very important, depreciation is covered under section 32, and section 32 allows a deduction in respect of depreciation resulting from the diminution or exhaustion in the value of certain capital assets. So students, whenever you're going to charge depreciation is charged on annual basis. So whenever you're going to charge depreciation, you have to debit it to the P&L account. Okay, so they're telling us that debit is being allowed as per section 32 as a deduction. When you're debiting it is obviously a deduction because you're going to minus that particular expenditure. Now, in your first semester, you all had seen depreciation from the angle of financial accounting. Now, today you all are going to see the depreciation from the angle of income tax, which is a quite different but more or less the same. So what are the assets eligible for depreciation? Now, when you are carrying out a business or profession, what are the different assets that are eligible for depreciation? So as we already know, assets are of two types. One is tangible asset and one is intangible asset. Now, depreciation in case of profits and gains from business or profession will be charged based on the block of assets. When I say block of assets means it will be categorized, and based on the category you have to charge depreciation. So students, the assets in respect of which depreciation is claimed must belong to either of the following category. So as I told you, block of assets means category of assets or class of assets. So I told you all tangible assets and intangible assets, like building, machinery, plant or furniture, which we can see is a tangible asset. Know-how, patent, copyright, trademark, franchisee, it becomes an intangible asset. So depreciation will be charged separately for tangible assets, separately for intangible assets. Next, conditions to be satisfied for allowance of depreciation means, can anyone claim depreciation or charge depreciation? No, there are certain conditions. So students, common sense, what can be the conditions to charge depreciation is, first, the asset on which I'm charging depreciation should belong to the SEC. So if the asset is not belonging to me, I cannot charge depreciation. So the first and foremost condition will be depreciation is allowed only to the owner of the asset. Okay. Now suppose if I am owning the asset partly, like partly I am owning it and some other person is owning it, the remaining part of it, then I will be allowed depreciation on the portion that I am owning. And the third condition is, depreciation can be claimed only on an asset which is used for business purpose or profession purpose. If you're using any asset for your household personal purpose, you cannot claim depreciation on that in your books of accounts. So let us see the different conditions. It is allowed only to the owner of the asset. The asset should be actually used by the SSC for the purpose of his business or profession during the previous year. So only if he's using it for the purpose of business or profession, then only he can claim the depreciation. Third, allowed even if the asset is wholly or partly owned by the SSC. It is not necessary that if he 100% owns the asset, then only he can claim depreciation. Suppose 50% or partly also is owned by the SSC, on that part portion he can claim depreciation. So these are the basic conditions which has to be satisfied in order to claim depreciation under section 32. Now, methods of depreciation. Students, as we already know, there are different methods of depreciation which we have seen in our financial accounting, but as I told you all, in income tax it is little different. In income tax, they follow two methods of depreciation, that is written down value method, which we already know what is the meaning of written down value method, and straight line method. But when is written down value method to be used and when is straight line method to be used? So usually usually depreciation under income tax is calculated on written down value method. Written down value method means what is the value of the asset at the end of the financial year or the previous year. Because depreciation is always charged at the end of the previous year or financial year. So what is the value of asset at the end of that year? We'll charge depreciation on that on written down value method. Now, when is straight line method to be used? It is to be used in case of those businesses which are engaged in the generation and distribution of power. At those businesses usually will claim depreciation on straight line method. So let us see. Depreciation is computed on the written down value method of the asset as on the last date of previous year. And in case of undertakings or businesses which are engaged in generation or distribution of power, the method that they use is straight line method of depreciation. Next is how to calculate the depreciation. See, as I already told you all, usually all the businesses under income tax, they follow the written down value method. And only in case of distribution and generation of power, straight line method is followed. So let us see how to compute this written down value method. How to get the value of the asset as on the last day of the previous year, so that we can charge depreciation on that. This is very, very important because you have problems on depreciation which will be majorly based on this particular format. Okay. First of all, you'll know that a particular financial year starts from 1st April and ends on 31st March of the succeeding year. So first you have to take the opening balance of the block of asset. Now suppose if the block of asset is building, then you need to take the WDV of the building. Suppose if it is furniture, you need to take the written down opening balance of that furniture. So WDV of the block of asset on the 1st April of the previous year. Suppose it is 1920. So as on 1st April 2019, what is the written down value of that particular asset has to be taken. Now, during the year, if you are acquiring assets which are belonging to that category or class, then you have to add actual cost of the asset falling within the block acquired during the previous year. Suppose if you are, for example, we are taking building as a block of asset. And suppose if you have purchased one more building during the year, previous year, you have to add that also to the value of the asset. Because initially I have told you all that in income tax, the depreciation is charged, or the assets eligible for depreciation will be based on the block of assets or categories of assets, class of assets, which are falling under the same category. So once you add this both, you will get the total value of the block of the assets. Now, from that block of assets, if you're selling some asset, so less money receivable in respect of any asset falling within the block which is sold, discarded, demolished during the previous year. If you're selling any portion of that asset, you have to deduct it. Then you will get WDV at the end of the year. How will you get it? Point number 3, total asset what you have minus the asset that you have sold, you will get WDV at the end of the year. Now, I told you all depreciation is charged on the WDV at the end of the year. So 6th, depreciation you have to charge at the prescribed rate. See, income tax has given the rate of depreciation for each category of assets or for each class of assets. So depending on the rate given under income tax, you have to charge the depreciation on the written down value method at the end of the year. So what is the rate of depreciation as per Income Tax Act into the written down value arrived at 5 above. So this is a format which is very simple. Take the opening balance of the block of asset. To that you add any purchases made on that block of assets. Then you minus any asset that you're selling, and then you get the WDV on which you're going to charge the depreciation. So on this amount, you're going to charge the depreciation at the rate which is specified under Income Tax Act. Next, assets acquired and put to use during the financial year. Suppose the financial year is 1920 and you have acquired any asset in the year 1920 and you have used that asset for less than 180 days. Suppose you have acquired it in January 20. So you're using that asset for less than 180 days. Then the rate of depreciation that you charge cannot be charged for the entire year. You have to charge the rate of depreciation is 50%. So suppose furniture, the rate of, suppose for plant and machinery, the rate of depreciation as per Income Tax Act is 15%. But if you're using that plant and machinery for less than 180 days in the previous year, then the rate you will charge is 50% of 15%, that is 7.5% will be the rate of depreciation that you're going to charge. So if the asset is put to use, if it is less than 180 days, you're putting the asset to use, then the depreciation rate will be 50% of the rate specified under the Income Tax Act. So suppose the rate for the whole year for building is 10%, but you're using the building, you acquired the building in the previous year and you're using it for less than 180 days, then you cannot charge full 10% on that building as depreciation. You got to charge 50% of 10%. That is 5% only will be allowed as depreciation. Reason being, the asset is put to use for less than 180 days. This is again very important when we solve the problems. So let us see what are the rates of depreciation as per Income Tax Act. So I'll just cover the major ones and the important ones. Now building, if it is a building that is used, okay, for commercial purpose, then it is 10% is the rate of depreciation. If it is a category belonging to furniture and fittings, the rate of depreciation is 10%. If it is a motor car, or you can say plant and machinery, then the rate of depreciation is 15% on plant and machinery. Remember, on buildings it is 10%, on furniture and fittings it is 10%, on plant and machinery it is 15%. Then you have different categories, like on aeroplanes it is 40%, on control equipments it is 40%, on plant and machinery used in semiconductor it is 30%, on life-saving medical equipments it is 40%, and so on. Similarly, on computers, including computer software, it is 40% rate of depreciation. On books, the rate of depreciation is 40%. Plant and machinery, I told you, 15% already. This is in case of tangible assets, which you can see. Now, in case of intangible assets, the rate of depreciation is 25%. So these are the different rates of depreciation which is specified under the Income Tax Act. Majorly for your exam point of view, they will ask what is the rate of depreciation on furniture, building, plant and machinery, computers, books, and on intangible assets. Now, can you all tell me, students, if I purchase a plant and machinery and I'm using it for less than 180 days, what is going to be the rate of depreciation that I'm going to charge?
Ma'am, 50%.
How much?
50%, ma'am.
50%.
50% of what?
Ma'am, rate of depreciation.
Half of the rate of depreciation.
So if the rate is 15%, I'm going to charge only 50% of 15%. So that is how much? 7.5%. Correct? Understood? Okay. Next, there is a concept of additional depreciation. Now, we have seen normal depreciation, which is covered under section 32. Now, you'll very well know what is depreciation, to which assets it is charged, what are the conditions, what are the methods, how to calculate. Now, we are going to see additional depreciation, which is over and above the normal depreciation, which is covered under section 32, subsection 1. Now, before reading this, just listen to what I'm saying. Additional depreciation is given only and only if you are if the SSA is purchasing a new plant and machinery. So remember, for old plant and machinery, additional depreciation is not given. So additional depreciation is given only on the new plant and machinery, and that too only on plant and machinery. and not on any other asset. So it is given on a new plant and machinery which is acquired by the SSE, okay, which is purchased by the SSE, but such SSE should be into the business of either manufacturing or production. Now, suppose if he's into the business of trading, he is not going to get additional depreciation. So pay attention on these minute things. To whom additional depreciation is given? Only and only to the SSE who is acquiring new plant and machinery and is in the business of manufacturing or production, or either generation or distribution of power. Now, what is the additional depreciation he will get? The rate of additional depreciation is flat 20% on the cost of the plant and machinery acquired. Now, suppose if he's acquired the plant and machinery and using it for less than 180 days, then obviously, as we know, the additional depreciation will be half of that. That is 10% of the actual cost. Next thing in this you need to know is, suppose if that manufacturing unit is being set up in any backward area, like in the state of Bihar, West Bengal, any backward area in those states, if the manufacturing unit is being set up, then the additional depreciation rate will be 35% of actual cost. And suppose if the plant and machinery in that particular area is used for less than 180 days, then again 15.5% will be the rate of depreciation, that is 50% of 35%. And the balance depreciation. Balance means he is eligible for additional depreciation of 35%. Since he used it for less than 180 days, for that particular financial year, he can claim only 7.5%, and the balance 7.5% he can claim in the next year. So this is all about additional depreciation. Let me just read this. Additional depreciation at the rate of 20% of actual cost of new plant and machinery acquired by the SSE engaged in the business of manufacture or production of any article or thing, or generation, transmission or distribution of power. But 10% of actual cost will be charged as additional depreciation if the asset is put to use for less than 180 days in the year of acquisition. 35% of actual cost, or 7.5% if the asset is put for less than 180 days, if the manufacturing undertaking is set up in a notified backward area in the state of AP, Bihar, Telangana, West Bengal on or after 1/4/2015. And in case of less than 180 days, the balance additional depreciation can be claimed in the next year. So this is all about additional depreciation. Additional depreciation will not be allowed on the following plant or machinery. So on these plant and machineries, you will not get depreciation. Which depreciation? Additional. Normal depreciation you will get. I'm talking about additional depreciation. That is ships, aircraft, road transport vehicles, office appliances, machinery previously used by any other person, because it becomes second-hand machinery. And I'm talking about additional depreciation is only given to the purchase of a new machinery. Next, machinery installed in any office premises, residential accommodation or guest house, you cannot claim additional depreciation. The machinery in respect of which the whole of the actual cost is allowed as a deduction in any one of the previous year. If you have already taken the whole of the amount as deduction in any of the previous year, you will again not get the additional depreciation on that. So in short, what does this mean? Only those new plant and machinery which are used for the production purpose, which are used for the factory purpose, which is used for the manufacturing purpose, only those plant and machinery are eligible for additional depreciation at the rate of 20%. 10% if it is used for less than 180 days. If it is a backward area of the state of Bihar, Telangana, AP, then it is going to be 35%. And if it is used for less than 180 days, it is going to be 7.5%. So by this, we have completed what is deemed profits, what is how to maintain the books of accounts, who has to maintain the books of accounts, where the books of accounts have to be maintained, and we have seen what is depreciation under section 32. We have seen additional depreciation under section 32 subsection 1. So by this we have completed a part of module 3. Thank you so much, students.